This article is about the public provision of productive services, such as education or healthcare. Indeed, many countries devote a significant share of their public expenditure to provide productive services that affect individual productivity. According to the empirical evidence, taxes and transfers are not the only instruments useful to redistribute income. In fact, also public services may favor a substantial income redistribution among households. Therefore, in this paper, we investigate the design of redistributive policies when the policy mix includes income taxation, cash benefits, and in-kind provisions. More specifically, we study a policy mix characterized by the public provision of a productive input and a nonlinear taxation scheme. In our model, the government may deliver a minimum amount of input using conditional transfers, like vouchers or tax allowances, whereas individuals are free to top up the basic public provision. If agents decide to top up this minimum amount, they can choose a second public provision, or they can buy the additional quantity of the input on the market. In line with previous studies, we assume that agents are heterogeneous in terms of innate abilities. However, we also consider the fact that individual private transactions are not always perfectly observable. Finally, we simulate our model by using US data. The main results of our study are the following. First of all, we found that the optimal redistribution policy depends on the relationship between innate abilities and the input. In particular, it depends on whether input and ability are substitutes or complements in the wage function. Second, three sufficient statistics influence this relationship. The first statistic is the Hixian coefficient of complementarity between input and ability. The second statistic is the compensated wage elasticity of labor supply, and the third statistic is the uncompensated wage elasticity. Using standard specifications for the utility and the wage function, we found that for reasonable values of these statistics, the two factors of production are substitutes in the wage function. Regarding the optimal policy, we show how this is based on both a nonlinear income taxation and a uniform level of public provision. This level must be sufficiently large to induce all households to opt for the public provision, even when they could buy the input on the market. This means that when the redistribution policies brings households to top up the public provision of input, then the marginal tax rate ultimately embeds an incentive to upset the public offer. We conclude the analysis with a numerical simulation in which the public input refers to educational services. There, by considering acceptable values of the Hixian coefficient of complementarity, we find robust evidence that education and innate abilities are substitutes in households' earnings. Let's talk about the implication of our work. From a positive point of view, our results suggest that the optimal tax formula should include incentives or disincentives to private investments in input. At the same time, in terms of empirical implications, papers aiming at estimate our three sufficient statistics should include time and country-specific changes in the public provision of social services. While actually, from a normative point of view, based on our theoretical results and empirical evidence on wage elasticity, we found that the US tax scheme is not efficient when there is a chance for universal provision of education. Indeed, we found robust evidence that the optimal redistribution policy for the US is a mix of non-linear income taxation and a generous universal public provision of education. More in general, policymakers should design a country-specific provision scheme based on whether inputs and abilities are substitutes or complements in the individual earnings. Thank you very much.